1 out of every 9 XRP available on the open market vanished in a single day, and most people didn't even notice. Now think about that for a moment. 6.5 billion XRP disappeared from exchanges almost overnight. This is not normal behavior. This is not retail investors playing around. This is something much bigger, much more organized, and much more powerful happening behind the scenes. Welcome back to BullionIQ, where we break down the real moves in the crypto market, not the noise, not the hype, just the raw facts and what they actually mean for your future. If you hold XRP, or if you are thinking about getting into XRP, this video is extremely important for you. Because what just happened is being called the largest coordinated XRP exodus in crypto history. Across almost every major centralized exchange in the world, XRP balances dropped by around 50%. Big names like Binance, Bithumb, Upbit, Uphold, eToro, and Bitbank all saw massive outflows at the exact same time. That is not a coincidence. That is synchronized action. And the biggest question right now is, where did all that XRP go and who took it? This is not retail traders pulling their coins into small wallets. Retail does not move billions at once. This kind of movement comes from institutions, large funds, ETFs, treasury companies, and OTC desks working together quietly in the background. These are organizations that don't buy on public exchanges in a way that moves the price. Instead, they use OTC desks and private deals, so the average person never sees the real demand building underneath the surface. A lot of this activity is connected to ETFs. ETF providers need huge amounts of XRP, and the supply on OTC desks is shrinking fast. So what happens when the OTC desks start running dry? They have to go somewhere else, and that's the public exchanges. They quietly pull massive amounts of XRP off these exchanges, move them into custody, and prepare them for larger financial products. And while they do this, the price stays almost still, giving a false sense that nothing is happening. But the truth is something massive is happening. This kind of supply drain is actually very bullish in the long term. When less XRP is available on exchanges, it becomes harder to buy. When something becomes harder to buy but demand stays strong or increases, the only natural result is higher prices. As the available supply gets lower and lower, even small amounts of buying pressure can cause large moves in price. That is where the supply shock idea comes from, and that is why so many analysts are getting excited right now. This does not mean the price will immediately explode tomorrow. Big players operate slowly and strategically. But it does suggest that XRP is being positioned for something much bigger in the long run. And the more XRP that leaves exchanges, the more powerful the next major move becomes. Right now, we are watching a silent accumulation phase on a historic level. This is not a rumor or theory. This is on-chain data which does not lie. The numbers are clear. Exchange balances that were once around 16 billion XRP are now near 6.5 billion. That is a massive drop in only a short period of time. That kind of change does not happen unless something important is developing. Welcome back to BullionIQ, the place where we break down crypto and finance in a simple, clear, and honest way so you can stay ahead of the crowd. Today's topic is something that honestly shocked even experienced people in the market. 1 out of every 9 XRP available on the open market vanished in just one single day. Think about that for a moment. Billions of XRP gone from exchanges almost overnight. This is not normal behavior, and it's not something caused by small retail traders clicking buy and sell on their phones. This is something bigger, coordinated, and most likely connected to institutions, ETFs, and large treasury companies quietly positioning themselves before the crowd understands what is really happening. Yesterday alone, around 6.5 billion XRP vanished from centralized exchanges. Almost every major exchange showed around a 50% drop in their XRP balances at the same time. Binance, Bithumb, Upbit, Uphold, eToro, Bitbank, and others all recorded massive outflows. This kind of perfectly synchronized movement does not happen by accident. Retail investors do not have the power, the money, or the coordination to do something of this size. This points toward large-scale players moving XRP off exchanges all at once. When coins leave exchanges at this speed, it usually means only a few things. Either people are moving their XRP to cold storage to hold long-term, institutions are transferring it to OTC desks for private deals, or it is being moved to prepare for something major like ETFs or tokenized assets. Now here's the most important part you need to understand. When supply on exchanges goes down, price pressure almost always goes up. If there is less XRP available to buy on open markets and demand stays the same or increases, then mathematically, price has only one direction to go, and that is up. This is basic supply and demand. As XRP becomes harder to find on exchanges, it becomes more valuable because buyers start competing with each other for the limited supply that remains. That is how you get explosive price moves. That is how supply shocks are born in the market. Some people might say this is just a reshuffle between exchanges or wallets, and yes, that is possible. A part of this movement could be internal transfers, balancing, or cold storage preparation. But even if that is true, the fact still remains that exchange balances have dropped massively. And that alone changes the game. Because whether it is in one wallet or another, it is no longer available for instant public trading. That means liquidity is tightening. And tight liquidity is very dangerous for anyone who is short, and very powerful for anyone who is holding. What makes this even more interesting is the role of ETFs. ETF providers do not usually buy on open exchanges. They buy from OTC desks in large private deals, so their buying does not move the price too fast. But now reports are saying that even OTC desks are starting to run low on XRP. When OTC supply drops, they are forced to go back to exchanges to find more liquidity. That could explain why we are seeing this massive drain from exchanges right now. Big players are quietly collecting XRP wherever they can find it. The scary part, or exciting part, depending on where you stand, is that this is happening while the price is still relatively calm. That tells us something important. The real action is happening in the background in back-channel deals far from the eyes of the average investor. These big institutions are not trying to create hype. They are trying to position themselves before the public realizes what is coming. So, the big question now becomes, where is all this XRP really going? And how long can this level of accumulation keep going before exchanges start to look completely empty? Because if this trend continues even for a few more months, we could be looking at one of the biggest supply squeezes in crypto history. And when that happens, the price could move in a way that most people think is impossible right now. This is only the beginning. In the next part, we are going to break down exactly who might be behind this massive XRP movement, how ETFs, treasury companies, and institutions are playing this game, and what it could mean for the next 12 to 24 months. Stay with me on BullionIQ because this is where things start to get really serious. Where did all that XRP actually go? And who is really behind this massive movement? When you see billions of coins leaving centralized exchanges, the first thing you should understand is that this is usually a sign of long-term intention, not short-term trading. Traders leave their coins on exchanges because they plan to buy and sell quickly. Long-term holders, funds, and institutions move their assets off exchanges because they want security and control. So this tells us straight away that the XRP being moved is most likely not meant to be traded in the short term. It is being positioned for something bigger. One very strong theory behind this is the rise of XRP-based ETFs. When an ETF is created, the company managing it must actually hold the underlying asset in large quantities. For a spot XRP ETF, that means they need real XRP, not paper contracts, not promises, but actual coins locked in custody. These ETF providers cannot just go on Binance and buy billions of dollars worth of XRP because that would send the price flying instantly and expose their strategy to the public. So they use OTC desks and private liquidity providers to build their positions slowly and quietly. But as more institutions start lining up for XRP exposure, the demand on OTC desks increases and the available supply there starts drying up. When OTC desks cannot meet the demand anymore, they are forced to source liquidity somewhere else, and the only place left is public exchanges. This could be one of the major reasons why we saw such a massive single-day outflow. It looks like a coordinated grab for available supply. Big players don't want to miss out on what they see as the next major financial layer built on blockchain technology, and XRP is right in the center of that conversation because of its speed, low fees, and strong connections with financial institutions. Another major factor that many people are ignoring is tokenization. The world is moving towards tokenizing real-world assets like real estate, government bonds, commodities, and even stocks. Massive amounts of value are expected to move onto blockchain networks over the next decade. XRP and the XRPL are being positioned as a possible backbone for this new tokenized financial system. If large firms believe that XRP will be used as a bridge asset in a tokenized world, then it makes perfect sense for them to start accumulating it as early as possible, before the rest of the world understands its true value. This is why we are seeing smart money move early. They don't wait for confirmation or headlines. They act when the risk is lower and the reward is higher. By the time headlines start shouting, XRP is the future of finance, these big players will already be fully positioned. The average investor usually arrives late, buying at much higher levels, wondering how others got in so early. But what we are seeing now is that early phase for a new wave of institutional crypto adoption. You might be thinking, if all this is happening, why is the price still not exploding? And that is a very important question. The simple answer is control and strategy. Big players do not want sudden spikes while they are still accumulating. They want slow, controlled movement so they can keep buying without attracting too much attention. That is why price can stay calm even while massive amounts of XRP are leaving the market. Under the surface, the foundation is being built. And when that foundation is complete, the move can be fast, aggressive, and shocking to people who are not paying attention. It is like a coiled spring. You don't see the pressure building inside, but once it is released, the movement is powerful and almost unstoppable. Right now, XRP is in that coiling phase. Silent accumulation, shrinking supply, rising long-term demand, real-world use cases, and growing interest from global institutions. All of the ingredients for a serious supply shock are starting to line up. We need to talk clearly about what a true supply shock actually is and why it has the power to change prices in a very dramatic way. A supply shock happens when the available amount of an asset suddenly becomes very limited, while the demand for that asset stays the same or even increases. When this happens, buyers start competing with each other. They are no longer asking, is this cheap? They are asking, can I even get it? And when something becomes hard to get, human psychology and basic economics combine to push the price up much faster than people expect. We have already seen this happen before in crypto, especially with Bitcoin. In the past, when large amounts of Bitcoin left exchanges and went into cold wallets, the available supply for trading became smaller and smaller. Each new bull cycle started at a time when the amount of Bitcoin on exchanges was at a multi-year low. Then came a surge of new buyers, media attention, FOMO, and institutional interest, and the price exploded. That is not a theory. That is history, and it is all recorded in on-chain data. Now, for the first time, we are seeing a similar pattern begin to form with XRP, and in some ways it is happening even faster. The big difference is that Bitcoin was always known to be scarce. Everyone understood there was a limited supply of 21 million coins. With XRP, many people assumed it was not rare because the total supply number looked big. But what people misunderstand is the difference between total supply and available supply. A huge portion of XRP is locked, held long-term, or controlled in ways that do not enter the daily trading market. What actually matters is how much is liquid and available to buy right now. And that number is shrinking at a shocking speed. Imagine walking into a store that used to have 1,000 items for sale, and suddenly there are only 100 left on the shelves, but the same number of people are trying to buy them. What happens? People start grabbing, prices go up, and panic buying begins. That is exactly how a supply shock works in financial markets. Now take that idea and scale it to a global level, with banks, hedge funds, and everyday investors all trying to get their hands on XRP at the same time. That is when moves become parabolic. Another important thing to understand is that XRP is not just a hype coin. It actually has a role in cross-border payments, liquidity solutions, and potential tokenization of real-world assets. That gives it real demand, not just speculative demand. If banks, financial companies, and governments start using blockchain for settlement and tokenization, they will need a bridge asset that is fast, cheap, and reliable. XRP was designed for exactly that purpose. That means demand for XRP does not only come from investors, but also from real-world businesses and systems. Now, as the supply on exchanges gets lower and lower, something dangerous starts to happen for short sellers and people who are betting against XRP. They may not be able to buy back the XRP they owe. That can lead to a short squeeze, where short sellers are forced to buy at higher and higher prices just to close their positions. This creates even more buying pressure on top of normal demand. We have seen this happen in stocks and crypto before, and when it happens, it creates explosive candles that shock the market. This is why the quiet phase we are in right now is so important. This is the phase where smart money accumulates, weak hands get shaken out, and the foundation for the next big move is built. The biggest mistake most people make is getting bored during this phase and walking away. Then, when things finally explode, they run back in, but by then the opportunity is much smaller and much riskier. Right now, XRP is sitting in a position where the risk-reward ratio is becoming more and more interesting for long-term thinkers. The exit of billions of XRP from exchanges is not something you ignore. It is something you study, prepare for, and position around if you understand what it could mean. It's time to explore another critical factor: the role of governments, central banks, and regulatory frameworks. When you are looking at any major financial asset, especially one like XRP that is being positioned for institutional adoption, you cannot ignore the regulatory environment. Governments and central banks have a huge influence on how an asset can be used, who can hold it, and how easily it can move between borders. This is particularly true for XRP because it is being designed as a bridge currency for payments and settlements across countries and currencies. That is why XRP is not just a speculative coin, it is a functional tool in the world of finance. One of the most interesting developments to watch is how exchanges and ETFs operate under US law and the oversight of agencies like the SEC. XRP is unique because Ripple has been heavily involved in regulatory discussions. The company has been invited to multiple global meetings where it talks about fintech solutions, cross-border payment systems, and tokenization. That level of engagement gives XRP a type of credibility that most cryptocurrencies do not have. When institutional investors see this, they become more confident that holding XRP is not just speculative, it is a strategic move to participate in a real financial system. At the same time, large financial clearinghouses are also paying attention to XRP. The DTCC, for example, has been exploring how digital assets can be integrated into settlement systems, but they emphasize one thing above all else: sufficient liquidity. Liquidity is not just about trading volume or market cap. It is about having enough high-quality assets that can be immediately used to settle payments, even in extreme stress scenarios. XRP is being designed to meet these standards, which means it can actually play a role in global financial operations, not just trading on exchanges. ETFs come into play here as well, because they provide a way for institutional investors to access XRP without having to manage custody themselves. ETFs accumulate XRP off-exchange, which reduces public supply even further. As we saw in the first parts, billions of XRP are leaving exchanges, much of which is likely being used to supply ETFs. This dual effect, reduced exchange supply and rising institutional demand, creates an environment where the next significant price move could be extraordinary. The infrastructure is being built quietly in the background, while the general public is still catching up to the idea. Another point worth noting is the potential for tokenized U.S. treasuries and other high-quality assets on the XRP ledger. Ripple has been working on projects that could allow tokenized securities to flow through the network, providing a new source of real-world demand. This is not just a concept, it is actively being explored with companies like BlackRock and Ondo. When tokenized financial assets become available on the XRP ledger, it will create yet another layer of demand that can absorb XRP supply quickly, especially from exchanges that are already seeing historic outflows. The combination of regulatory clarity, institutional adoption, and functional utility makes XRP very different from other cryptocurrencies. While the average retail investor might be focusing on price charts and social media hype, the real story is being written behind the scenes by companies, ETFs, and regulators. These players are quietly accumulating XRP, moving supply off exchanges, and preparing for a financial system where XRP plays a central role. This is why timing matters. Retail investors who ignore these signals risk missing out on early positioning, while institutions quietly build their exposure. It's time to break down what this all could mean over the next 12 to 24 months. When we look at the current rate of XRP accumulation, especially through ETFs and institutional wallets, the trend suggests that available exchange supply could become extremely limited in just a year or two. Right now, we are seeing between 500 million to 1 billion XRP being absorbed into ETFs every month. If this pace continues, public exchanges could be left with very little XRP for everyday traders. That is the essence of a liquidity squeeze. The fewer coins on exchanges, the higher the potential price impact when someone wants to buy. Let's put this into perspective. Earlier this year, there were about 16 billion XRP on exchanges. Today, that number has fallen to roughly 6.5 billion. That is a huge drop in a very short time. It's not just a coincidence. This is institutional and ETF accumulation, coupled with private transfers to cold storage and other long-term holding strategies. When you look at these numbers, the path toward a supply crunch becomes clear. The more XRP is held off exchanges, the more scarcity affects price dynamics, and the more influence large holders have over market movements. Now, here is where the strategy gets interesting. If exchange supply continues to shrink at this rate, new buyers, both retail and institutional, will have to compete for the remaining coins. Imagine trying to buy XRP when there are only a few billion left globally on exchanges, with hundreds of millions being taken off every month. Every purchase puts upward pressure on the price. The so-called market cap multiplier effect starts to take shape. Small inflows create bigger and bigger market moves, especially as supply keeps tightening. That is how massive price jumps happen quietly, before the headlines even notice. Another important aspect is long-term holders. Institutions aren't buying XRP just to flip it in a few months. Many of them are taking a 5, 10, or even 20-year view. They understand the potential for XRP to serve as a bridge asset for tokenization, cross-border payments, and financial infrastructure. This is critical because it means a large portion of the XRP being accumulated today may never return to exchanges. That creates a permanent reduction in liquid supply, which is far more impactful than temporary trading activity. Even retail investors should pay attention here. The risk is simple. If you wait too long to get in, you could be buying when supply is extremely tight at much higher prices. On the other hand, understanding the trend now allows you to position yourself strategically. Watching exchange outflows, ETF accumulation rates, and OTC desk activity gives insight into when the next big moves could happen. Tracking these metrics is like having a map for the next phase of the market. There are also potential wildcards to consider. Large funds like BlackRock, Fidelity, or Vanguard could enter the XRP market with new products. If that happens, the demand could spike even faster, accelerating the depletion of exchange supply. Add to that the slow but steady removal of XRP for self-custody and cold storage, and you start to see how the market could become extremely tight in a relatively short period. In some models, the current exchange supply could be largely gone in just 12 to 18 months if these trends continue. Finally, XRP is not just about speculation, it's about utility. As more financial systems explore tokenized assets, stablecoins, and cross-border payments, demand from institutions could continue to grow, independent of retail hype. This makes the supply squeeze not only likely, but also structurally built into the system. Understanding this gives you the edge to interpret price moves and market behavior with a professional lens. Let's connect everything we've discussed so far and look at the bigger picture of XRP's future. We've talked about exchange outflows, ETFs, institutional accumulation, supply shocks, and regulatory factors. When we combine all of these elements, we see a clear story forming. XRP is moving into a phase where its available supply is shrinking rapidly, while demand, especially from serious institutions and ETFs, is growing steadily. This is the perfect setup for a liquidity squeeze. The fewer coins that are freely available on exchanges, the stronger the upward price pressure becomes, especially if long-term holders continue to keep their XRP off-market. One key point is that not all XRP is available for immediate trading. Ripple controls escrowed XRP, which releases 1 billion coins per month, but even that is tightly monitored and cannot be dumped into the market indiscriminately due to legal constraints and market impact concerns. So, while the total supply is high, the liquid supply, the XRP you can buy quickly on exchanges, is shrinking. This is the critical factor. Supply scarcity on exchanges combined with growing institutional demand can create explosive price movements, similar to what we've seen with Bitcoin during its own supply squeezes, but potentially faster because ETFs and private accumulation are concentrated in fewer hands. It's also essential to understand that these movements are not random. Institutions and ETFs are acting strategically, accumulating XRP quietly, mostly off exchange, to avoid driving up the price too early. OTC desks are being tapped for supply. Exchanges are seeing massive withdrawals, and coins are being transferred to self-custody and cold wallets. This means the foundation for the next big phase of price growth is already being laid in the background, away from the public eye. The average retail investor often sees the price and thinks nothing is happening, but under the surface, the market structure is shifting significantly. Looking forward, if ETF accumulation continues at current rates, absorbing 500 million to 1 billion XRP per month, the visible exchange supply could be very low in just 12 to 18 months. Add potential new funds from large players like BlackRock or Fidelity, and the timeline could shorten even further. Once exchange supply drops below critical thresholds, even relatively small buying pressure can create sharp price spikes. This is where early understanding and strategic positioning become powerful. Investors who recognize these patterns and prepare accordingly can avoid being caught off guard when a parabolic move occurs. Another important factor is real-world utility. XRP isn't just being accumulated for speculative purposes. Banks, financial institutions, and governments are actively exploring XRP for cross-border payments, tokenized assets, and settlement infrastructure. When XRP is used as a bridge asset in these systems, demand isn't just speculative, it's structural. This means supply will continue to tighten as more coins are removed from public trading and locked into long-term use, further reinforcing the potential for future price growth. Finally, while the opportunity is exciting, it's also important to be realistic. Market volatility will still exist, and events like regulatory updates or unexpected macroeconomic factors can affect price. That's why understanding the fundamentals, tracking exchange outflows, monitoring ETF accumulation, and watching institutional activity is critical for anyone serious about XRP. Knowledge and preparation are the real advantages here. So, to summarize, XRP is entering a period of tightening supply, growing institutional demand, and increasing real-world adoption. Exchanges are seeing historic outflows, ETFs are accumulating off-market, and long-term holders are reducing liquid supply. The groundwork for a major liquidity squeeze is being laid, and the next 12 to 24 months could define XRP's trajectory for years to come. If you understand this early, you can position yourself strategically rather than reactively in what may become one of the most interesting chapters in crypto history.